You ever get that feeling at the grocery store? You look in your cart and it feels kind of empty, but then you get to the checkout and the bill is way higher than you expected? Or when you fill up your car and that number on the pump just seems to take a bigger and bigger bite out of your paycheck? Yeah, we've all been there.
It really all comes down to this one big question. And it's not just a feeling you're having, it's a real economic force. It's called inflation. And to really get what that means, let's just start with a super simple definition.
Okay, the easiest way to wrap your head around inflation is to think about a shopping basket. Just imagine a standard basket of stuff a normal family buys groceries, gas, you name it. If that basket cost you $100 last year and this year it costs 105, well, that's a 5% inflation rate. It's not about the price of milk going up, it's about the average price of everything rising, slowly eating away at the power of every single dollar you have. Now, when you learn about this stuff in school, inflation is usually talked about as this big, universal thing that pretty much affects everybody in the same way. So let's quickly run through those basics. The main thing to get is that inflation is like a slow leak in your wallet's value. If you've got cash just sitting in a savings account, inflation is silently chipping away at what it can actually buy. It really hits people on fixed incomes hard, like retirees. Their check is the same every month, but prices keep going up. But here's where it gets interesting. It can actually help some people, especially those with certain kinds of debt. Think of it like a seesaw. This is a key thing about inflation. It moves wealth around. If you have a fixed rate mortgage, for example, inflation's kind of your friend. Why? Because you're paying back your loan years from now with dollars that are worth less than the dollars you borrowed. But if you're the one who lent the money, you're getting paid back with cash that can't buy as much. So we've got this big force with these known effects. But does it really hit us all the same? And here is where the simple textbook story just falls apart. Is that shopping basket we talked about, is it really the same for a billionaire and someone working a minimum wage job? Does that one single number you hear on the news actually capture your reality?
As it turns out, the answer is a huge, resounding no. We've got to stop thinking about one inflation rate and start talking about something called inflation inequality. It's really a tale of two completely different shopping baskets. And look, this isn't some wild new theory. This is Austin Goolsbee, a top economist. The experts are starting to realize that if we're only talking about how much money people make, we're missing half the story. The very thing that devalues our money is doing it unequally. So why does inflation slam some people so much harder than others? Well, it boils down to two really powerful ideas: what we buy and how even tiny differences can blow up over time. This chart just lays it out perfectly. For lower income families, a whopping 57% of their entire budget goes to just housing and food. For higher income folks, it's about 43%. Now, why is that a huge deal? Because the prices of essentials, rent, gas, groceries, they tend to be the most volatile. They can shoot up way faster than the price of, say, a new TV or a vacation. Their shopping basket is just way more exposed to these price shocks. Okay, so in 1 year, the difference in the inflation rate between a rich and poor household might look small, a fraction of a percent maybe. You'd think, what's the big deal? Well, that's where the incredible and, in this case, incredibly destructive power of compounding comes in. What happens when that tiny difference builds up year after year for decades? Just look at this number. It's insane! Researchers dug into the data, and over about 40 years, the total impact of those slightly higher inflation rates meant that the cost of living for the poorest households went up 43 percentage points more than it did for the wealthiest. That is a massive, life-altering gap built one tiny percent at a time. And if you thought that was bad, this chart shows you the real gut punch. Think about it. A $1 price hike on a gallon of gas hurts a family making $30,000 a year way more than a family making $300,000. So when we adjust for that real-world impact, what we could call purchasing power-adjusted inflation, the gap just explodes. The real felt inflation for the lowest income folks was a staggering 76% over this period. For the top, just 9%. This is what inflation's unequal burden actually looks like. So, what does this all mean? If inflation is this unequal, it raises a huge question for the people in charge of controlling it, like the world's central banks. How do they even begin to factor this into their decisions? Well, here's the official view from the top.
Fed Chair Jerome Powell is basically saying their number one job is to keep prices stable. The thinking is that taming inflation is the best thing they can do to help everyone because it creates a predictable environment where the job market can be strong for everybody.
And what's their main weapon in this fight? It's actually pretty simple. They raise interest rates. That makes it more expensive for you to get a car loan or a mortgage and for a business to borrow money to expand. The whole point is to deliberately put the brakes on the economy, slow down spending, and give supply a chance to catch up. That, in theory, brings prices back under control.
For years and years, the magic number that all these policymakers have aimed for is 2%. A little bit of inflation is actually seen as a good thing. It keeps the wheels of the economy turning. So this 2% target, it's like the North Star for economic policy all over the globe.
But this brings us right back to the enormous final question. After everything we've seen, the different baskets, the crushing power of compounding, the massive chasm in who feels the pain, what does a single 2% target really mean? If one person's actual inflation rate is 9% and another's is 76%, can we honestly say we have price stability? It's a question that really makes you rethink the very tools we use to measure and manage our economy.